Welcome to the Accendo Traders Group. This is our weekend wrap-up trading plan for April 2nd, 2010. Our website is blog.accendotrader.com, where we put together effective video, technical analysis trading plans on a daily basis. We use a trading plan to keep us focused and disciplined. It allows us to keep abreast of what's coming down the market that can affect our open trends and as we scan for new trades. And it cuts on our research time so we can spend time with our family. The week that was, well, we had all three major indices end up for the week. Again, as we know, the market can do that in one day, so it's not that great. But overall, we did see the market continue to make gains on low vol trading, and of course, the market is closed today, being April 2nd. We saw 8 out of the 10 sectors advance higher, led by energy. Energy's moved up, could have been, and the dollar following could be the result of the offshore drilling announcement. Commodities rose 3.4%, and again the dollar fell 1.3%. Economic day really didn't have much impact on the market. The March consumer confidence did rebound up to 52.5, above 50 is bullish. ADP really didn't have anything on the market, and today being Friday when the market's being closed, we had unemployment released at staying at 9.7%. So overall, economic data didn't do that much. We did have some impact with corporate news. We haven't really talked about corporate news in a while. RIM posted disappointing earnings. And then Apple showed a move up when the rumors of the iPhone on Verizon came out again. And of course, we know tomorrow is the release of the iPad. So a little corporate news this week. And keep in mind that we're getting ready to approach the third quarter earnings, or I guess what would be second quarter earnings coming up. Not this upcoming week, but the week after that, Alco will be kicking off the next round of earnings. So this week, nothing much going on. We do have the FOMC minutes. Maybe there's some language in there on Tuesday. Overall, I'm not sure if we have a catalyst that's going to bring volume back. And of course, that might be why we have such low volume. So we'll see what happens next week. We have ISM services and home sales on Monday. No real major earnings this week. We do have Monsanto, but nothing that big. And then there are our 3 plays that we're watching. Let's go ahead and take a look at the internals. The main thing that I want to point out on the internals is, I think it's clear you can see, especially over the last week and a half here, that, our breadth numbers have been pretty much close to par. So that's not, too alarming. That's why we're consolidating. The other thing is that you'll notice that on our percentage pickups on the volume, typically those are all of our bearish days. So volume picks up on our down days, and that kind of talks about why there is no volume. Well, the puts, the bears, haven't really jumped in yet, potentially. And the other thing to point out is going right here on the NASDAQ breadth, and the NASDAQ breadth yesterday was negative. Just barely, but it was negative. And so that's a little divergence, as we had a great positive NYSE breadth number, but we did have a little divergence on the NASDAQ. So let's take a look at the charts. Here we have the Dow Jones. We're looking at the daily chart. And first and foremost, you can see such a lovely uptrend line that we have going on from the February lows. Click down here, drag it on up. So you can see we're actually doing pretty good. If we would have gone down yesterday, that would have been a break of this uptrend line. So that seems to be working out fine as far as support. The second thing you'll notice is that our bearish days, again, are where we're lining up with the increase in volumes. So again, I guess that's where our bears are coming in. And then the final thing we're going to see is that we have a little ledge going on right here at this 10,800 level. That's acting as support. And then we have our wicks up here at the upper 10,900 level, 9,950 level, that is acting as resistance. So we're pausing here. And I think last week we talked about, we're pulling off of the band. And you can see that a 10 moving average is also holding up as support as we look at this short-term uptrend line from the lows of February. So, the question is where we're going to go from here, and what's going to be the catalyst. Right now, don't know. Maybe we're sitting around waiting until the next round of earnings come out and see what people believe in those. But basically where we are is, put your alert. Last week we said a pullback to the 20 moving average would be healthy. And at this point it probably would, because by the time we get there, it probably would be around this 10,800 level. Certainly would be healthy. So I would put my alert around this 10,800. If we break that, we're going down. If we break 11,000, let's head on up. Now with the NASDAQ, it's a little different from the standpoint of we've had a better show of volume. Of course, again, the red days are the stronger or the higher volume levels. But the other thing you'll notice is that we've had more red days on the NASDAQ than we had on the S&P 500 and the Dow. We do have a little ledge going on here. Certainly we have our resistance at this 2420 level on the NASDAQ. And you're probably getting your support around 2380 as your support, and still believe the same thing. A healthy pullback to the 20 moving average would be great, and that still keeps us above the January highs. So, again, not really sure which way we're going to go. I think the market is looking for a direction. I think it's looking for a catalyst, and we still have to define what that catalyst is going to be. When we put this one on the Bollinger Band, you can see we pulled off, and you can also see that the tightening of the band. So there certainly is some congestion building up for a good potential move. Which direction will it be? Finally, the S&P 500. So we see our theme of the day of the ledge, the support level that we're forming in here. Support in this 1165 range, and then our wicks are up here. Probably in around 1180 range, and that's certainly fine. And just like we said before, what's going to be the catalyst? We still think a pullback to the 20 moving average is healthy, keeps us above the January high, so we can still keep this as a new swing high. But just being honest, who knows which way we're going to go? We need a catalyst. Let's switch over to the monthly charts. We still believe in the psychological boost of staying above the 50 moving average on the monthly chart, and we still think that when you look at this congestion in here, that's where we're kind of pausing also at this 1180 range. So we are at a good pausing place. We are at a good resistance place, but I think it's just important that we stay above the 50 moving average as we congest, consolidate, possibly pull back. Now you can see that the S&P is catching up to the NASDAQ as far as retracing this whole move, but let's take a look at the NASDAQ. Again, we've been really impressed with the NASDAQ. It's taken basically the whole move out. We've broken out of this congestion range. This was the resistance level that we talked about last week. And we've broken above that. Resistance here, support here. So now the next area that we're looking at is basically 2,500. So that's our next target if we continue to move up. But remember, we're starting to see more pausing, more bearish divergence, more bearish candles on the NASDAQ than we are with the Dow and the S&P. And the NASDAQ, as you can see, is what led us up. So it'll be interesting if the NASDAQ is what leads us back down, especially if the earnings of the tech companies aren't what people are looking for. Finally, the Dow. The Dow is above the 50 moving average, which is great, a little bit more than the S&P 500. You can see the resistance from the levels over here and the consolidation over here is where we're at. So we're at a good resistance level, a good pausing point, and we just want the retracement to stay above the 50 moving average. Moving on to the education portion of our video, we're using the book Trade Your Way to Financial Freedom by Dr. Van Tharp. And in this part of the book, he recognizes, or he states that successful traders know that the true holy grail is internal success. I mean, this really goes good off of us finishing Trading in the Zone by Mark Douglas. Being able to control your emotions, be able to be disciplined and focused is what make people successful traders. You know, when he says that successful traders are able to control their risk, that's about people who are able to follow a routine, a system, discipline, and not load up when they're not supposed to, and not get emotional and not stay in a trade when they're not supposed to. And the same thing with speculators. They cut their losses and keep them small. They don't blow out their accounts, and they let their winners run. And so you don't need to have a 100% success rate, because it's all about letting your winners run and cutting your losses when they're short. And finally, the conservative investors or contrarians, well, yes, they do what other people won't, are afraid to do, and that is being disciplined, and that is following a system and developing a system that fits their risk. You guys know about our partners: a great trading room, 10-day trial, futures broker, e-mini margins as low as $300, a great charting platform, and a futures trading plan to jumpstart your trading. Feel free to donate to us if you enjoy our videos, and trade at your own risk, and I'll see you guys next time.